but we don't think being cap weighted in the small and mid cap universe is the appropriate way to invest. We think that using quality and dividend growth streams can and has historically enhanced the risk reward profile of a small cap allocation.
So, Paul, we hear small cap stocks could be the beneficiary of an accelerating U.S. economy coupled with favorable monetary policies. Targeting this area is the ALPS O-Shares U.S. Small Cap Quality Dividend ETF, OUSM. Tell us why small cap stocks are important today.
Well, I think they're important today, and broader market history tells us that they're important from an asset allocation perspective. They're a diversifier. They offer different economic exposures, but also historically, they've been additive to the total return of a diversified asset allocation. The problem is that in this most recent cycle, small caps really haven't participated to the extent that you might expect them to. And if you look at the spread between the S&P 500 and the Russell 2000 just on price alone, you have to go back 25 years or so to see the last time we were at these levels. So on a relative basis, small caps have continued to deteriorate in terms of the relative valuation of the universe versus large caps. In addition to that, depending on what your favored valuation measure is, price to earnings or otherwise, they're trading at a deep discount to the relationship they've typically had with large caps. And there's a number of reasons for that. If you look at the Russell 2000, as we've talked about previously, it is a universe that's full of warts. There's a number of companies, as much as 40%, that are unprofitable. There's a lot of leverage, much of which is floating rate. And so when you think about the pertinent economic dynamics that have driven this market over the course of the past couple of years through this Fed rate hiking cycle, it's been the level of leverage, which has been punished. It's been the level of profitability and profit margin. Companies without profits and with poor profit margins have ultimately been punished relative to companies that have better profitability characteristics and higher quality characteristics. And so I do agree at a high level that the opportunity for small caps to mean revert, meaning close that gap in valuation to large caps on the back of expected strong, robust earnings growth in 2025 is appealing. But I also think a lot of those problems in small caps aren't necessarily going to go away because we've gotten 100 basis points of rate cuts from the Fed. We're expected to get another 75 or so basis points of rate cuts from the Fed here in 2025. Those problems are going to persist for the companies that have been punished in there. So what we're advocating advisors and investors do is take that universe and try your best to sort of remove as many of those problematic exposures as possible. And what OUSM does is it focuses on high ROA, so profitability on your asset base, low leverage, net debt to EBITDA, companies that have grown a dividend and have well-covered dividends. So the idea is this is a universe that has a lot of problems, has a lot of challenges in terms of the nature of the companies there. They are domestically oriented, so sort of a reacceleration in economic activity, deregulation, maybe additional M&A activity may disproportionately benefit some of these smaller cap companies, but we don't think being cap weighted in the small and mid cap universe is the appropriate way to invest. We think that using quality and dividend growth streams can and has historically enhanced the risk reward profile of a small cap allocation.
Always good to get back to basics. Now, turning to the political landscape, the Trump administration's policies of economic expansion through spending are inflationary. And that could be bullish for ETFs like the ALPS Active REIT ETF, ticker REIT, which targets the real estate sector. How do you see it?
Yeah, so real estate has always been bucketed by investors in the real assets category, and there's a perception, earned or otherwise, that real assets provide some inflation protection in a diversified asset allocation strategy. We tend to agree at a high level that REITs are a compelling way to affect a real asset strategy and to provide some inflation protection within a diversified asset allocation framework. But it's also important to note that the nature of these businesses, short-term leases that tend to reset higher along with inflation, is one of the characteristics that makes REITs unique. But also, you talk about politics, and I'm going to try and sort of stay off the third rail as much as possible, but we've seen some policy proposals, and even in the early stages of this incoming administration, we've already seen some policy implementations, including some significant investment in AI-related infrastructure, specifically the data center space. And REITs are one of the ways that you can play the investment in AI infrastructure and specifically the data center space, because there are companies in the publicly traded REIT market. They're some of the largest owners and operators of data centers. And so what's unique about REIT is, first of all, it's actively managed. It's run by a team, GSI Capital, that was spun out of Green Street, the foremost authority on real estate research on Wall Street, both public and private. And this is a way to play the REIT category in a high conviction way, leveraging the insights and expertise of a team with a great track record of managing and doing research, bottom-up fundamental analysis, valuation work on real estate investment trusts. And so there are some tailwinds economically. Historically, REITs have done well, coming out of a hiking cycle, I should say, going into an easing cycle. But what's unique about this latest cycle is, as you know, is that even though the Fed began cutting rates in the fall of 2024, 10-year rates actually started to go up. And that's not the typical path of 10-year rates when the Fed is beginning an easing cycle. And so that has undermined the REIT sector. And it's one of the reasons why it's lagged largely in 2024. But on a go-forward basis, there are a lot of things to like about the REIT segment. Traditionally, there is a very high yield characteristic relative to other equity income producing asset classes, but also importantly, some of those economic dynamics and some of these secular trends may disproportionately benefit companies in the space. And the case we're making for REIT is that you can hire an active manager who knows this space inside out and can tilt and tweak exposures among the different sub-industries within the REIT category in order to potentially benefit from some of these secular and near-term tailwinds.
Makes sense. All right. Switching gears a bit. If there's one thing buildings need, it's energy. The Alerian Energy Infrastructure ETF, ticker ENFR, has jumped more than 50% over the past year and has outpaced the S&P 500 energy sector by a wide margin. What, in your opinion, is behind ENFR's strong performance, and what do you predict is ahead?
Well, what's unique about energy infrastructure is that within the energy space, the business model is just so distinct. So many energy companies, the big ones at the top of the cap spectrum, the Exxon, the Chevrons of the world, as well as the service companies, the refining, the E&P companies, are highly dependent on the price of WTI, the price of oil. And if you look at full year 2024 for the price of oil, what we saw was oil was effectively flat. It was a long, choppy road to get there, but that does not necessarily portend a strong returns from the energy sector, despite some of the fundamental improvements those companies have made. Within the sector is this unique category of companies that own and operate energy infrastructure assets, pipelines, storage facilities, processing facilities, fractionation capabilities for NGL or natural gas liquids has been an emergent profit driver in the space, as well as increasingly an LNG export opportunity that continues to grow and will continue to grow over the next 3 years. And that business is pretty stable relative to the rest of the energy space. It's not spread based, so it's not based on what you pull it out of the ground for and what you sell it for in the market. It's really fees based on how much volume is moved through the network or how much is processed or stored. And so in that way, the stability of the business has differentiated it from the broader energy sector. And some of the tailwinds in this space are the same tailwinds we just talked about with the data center space within REITs, specifically the investment in energy infrastructure needed to support the increasing electricity demand that is going to support all of these data centers that the hyperscalers are investing in. And so some of the performance in 2024 you could attribute to a sort of knock-on effect of this AI investment surge that we're seeing, and the companies trying to secure reliable electricity generation, which in the United States largely means electricity generated by natural gas. And the companies in the energy infrastructure space own the long-haul natural gas pipelines and the facilities that support the transport and processing of crude oil and natural gas from where it's produced to ultimately where it is consumed. And that consumption base is changing. We're going to be exporting more of that natural gas abroad to Europe and to Asia. We're also going to see more of that natural gas being consumed to generate electricity to support all of the infrastructure needed to support AI. And so in many ways, it's playing on this story that most people think about as a tech story, but it's also the stability of the space in terms of how they generate their revenues. And if you look at the free cash flow yield on the energy infrastructure space as measured by ENFR, the free cash flow yield on the space is still double that of the S&P 500. It's 200 basis points higher than that of the energy sector. So in many ways, despite the strong performance in 2024, the strong relative performance to energy in 2023, the space's multiples, the valuation, hasn't necessarily got as extended as we've seen in the broad market, where we're trading at historically high CAPE ratios. You've got leadership sectors like technology trading 8 or 9 turns above the market. So in many ways, the opportunity for energy infrastructure, we feel, is similar to the opportunity that presented itself to this space 2, 3, 4, 5 years ago. And over the course of the past 5 years, it's compounded total return at about 15% without seeing significant multiple expansion. So that valuation, that macro, and that fundamental story continues to underpin the opportunity in energy infrastructure, especially for income-oriented investors who are looking for income from the equity portion of their asset allocation.
Yeah, I agree. Energy continues to grow in importance. The ALPS CoreCommodity Natural Resources ETF, ticker CCNR, is a recent addition to your ETF lineup. Can you tell us more about natural resources and CCNR's unique approach to investing in this category?
Yeah, so what's interesting about CCNR, it was actually spun out of a mutual fund from our partners at CoreCommodities, which was a strategy that combines physical or futures-based exposure with exposure in the equities of companies who are mining for, exploring for, and producing various natural resources globally, in fact. And so CCNR provided exposure to those equities and is now spun out into an ETF wrapper. But as you mentioned, it's an actively managed way to get exposure to a global portfolio of natural resource companies spanning all of these emerging and entrenched segments of the natural resources space. And the CoreCommodities team has been doing this, managing portfolios in this category for decades. And ultimately, what this portfolio provides to investors is a way to diversify their equity exposure from some of the key categories that dominate a typical equity allocation. As we mentioned, things like technology, comm services, and financials have had, at least historically, relatively low correlations to those other equity segments. And importantly, allows you to lean on the expertise of the CoreCommodities team to go out and find those companies globally who are fundamentally, valuation-wise, and executionally or operationally, I should say, driving the opportunity in what many people at the CoreCommodities firm, as well as our partners at USCF, believe is a global commodities supercycle that is being driven by a lot of the same trends: AI investment spend, electrification of the economy, all of which increases demand for a lot of the key commodities that the companies in CCNR are out exploring the world, trying to provide to their customers.
And that sounds like an ETF that covers many bases. So just one more question for you, Paul, before you take off. Some fixed income investors have been rocked by higher volatility. The ALPS Smith Core Plus Bond ETF, ticker SMTH, could be one solution for bond investors and advisors with fixed income clients looking for a smoother ride. Can you explain why?
Yeah, so SMTH launched in December of 2023 with $2.5 million in seed. It's since grown to over $1.4 billion in AUM. And in many ways, that speaks to the opportunity in active fixed income ETFs writ large. It was a record year for active ETF inflows, specifically fixed income ETFs in the active wrapper saw a tremendous amount of inflows in 2024. And that, I think, in many ways is investors and allocators and advisors working on behalf of investors, waking up to the realization that you could expect, and we have seen at times, equity-like volatility from the fixed income side of an asset allocation. And in those environments, we feel strongly that having an experienced, tenured manager to help shepherd you through the challenging environment that proves to be 2025 and has proven to be the past couple of years in fixed income is paramount. And SMTH is run by a guy named Gibson Smith, who is sort of one of the best kept secrets in fixed income, in the sense that he was CIO at Janus and helped grow that complex from $1 billion or so to around $40 billion in AUM, and has been managing fixed income products through various market cycles, has effectively seen it all in terms of changes in fixed income markets, changes in portfolio structure, and the ETF wrapper's flexibility has been attractive to those investors who might have been interested in the mutual fund but preferred the ETF wrapper. So in many ways, when you think about what transpired since the Fed begun easing last fall and the backup we've seen in 10-year rates, that is in many ways reflective of how different the market expectations can be and how the market can actually manifest. And having someone in a team as well versed and as well experienced in managing through challenging fixed income environments is extremely important. So what SMTH allows advisors and investors to do is allocate the fixed income sleeve of their asset allocation using a management team whose goal is simply to provide a ballast to your portfolio. Manage a fixed income portfolio like a fixed income portfolio was designed to provide stability and balance to offset some of the volatility you get in equities. And historically, this is a portfolio management team that has proven its stripes time and time again through thick and thin in the fixed income market.
Remember that phrase, bond bores? Well, there's nothing boring about bonds anymore. Paul, thank you so much for your timely insights.
My pleasure. Thanks for having me once again.
And be sure to visit alpsfunds.com to learn more about the ETF lineup at SS&C ALPS Advisors. I'm Thalia Hayden with ETF Guide. Thanks for watching, and we'll see you next time.